Welcome to Creative Insights, the workshop for financial advisors, insurance professionals, and fiduciary consultants. Today's workshop, Why Financial Product Costs Need to be Disclosed, Part 3 of our 5-part series entitled The Power of Tax-Free Retirement Income. In this segment, I want to talk about financial product fees. Now, almost all financial product fees have some costs associated with the management and the marketing of the actual product. So everybody has the same issues to deal with. Now, as an example, and I'm security licensed and have been selling I've sold mutual funds in the past, ETFs, REITs, different products. They all seem to have some kind of a product load to them. Now, when I'm looking at a regular fund expense load, this is a curiosity to many of my clients and surprisingly to some of my financial advisors and registered investment advisors, because they don't really look at everything all in. Now, for years, they've looked at life insurance. We've been kind of, castigated in a negative way because of our expenses. And ever since we invented universal life, whether it's universal life fixed interest or universal life indexing or universal life with variable subaccounts, we have been disclosing the actual expenses on the illustration. So it's current company practice under those expenses. But we've been doing that for years and years. It's interesting to note as I walk through some of this that you're going to say, Steve, I did not know that that was part of a mutual fund or an ETF expense. They're all different. You're going to have to make sure that you have to go out to the to their website and find out what it is, because some of these expenses are not embedded in the prospectus, oddly enough. So let's just talk about this a little bit. Fund expense. Now, the average load may be, I don't know, and we're going to get to this in a second, about 90 basis points maybe. It's going to be a little higher, a little bit lower. But most of the more efficient and more effective funds, we're trying to pay around between 90 and maybe 100 basis points just for the fund itself. But the surprise is really in the statement of additional information, which is not part of the prospectus, and you can always order it as a client or an advisor, but there's no real requirement for it. Now, the statement of additional information is going to have all the trading costs involved, any other expenses that are involved in the fund, and generally, and I'll show you in a moment, that number really exceeds 100 plus basis points, and that adds to the actual tab of an actual purchase of a mutual fund or an ETF as my example. And then, of course, you have the registered investment advisor fee. There's an asset under management fee. That goes on top of that. And then if you have this money in qualified plans, there might be administration costs within your 401k you may have to pay. And remember, starting about 4 years ago in September, the government opened up a whole new part of the code called 408B2, where you actually have to disclose all the expense loads of not only the qualified plan, but everything that's going on in the fees. And oddly enough, some, not all, but some of the contracts that we've seen, 401k plans, I have seen some omission on the statement of additional information. Most of them have already went that way. We're seeing all the price tag all in. It should be fully disclosed to the client. We should get a pretty good understanding, what are we paying to be in the plan and what are we paying for the actual fund product that we're using. And I also, remember, I have 404A5 charges and 404C3 maintenance compliance issues that sometimes are actually put inside the administration cost of a plan. So it's not only looking for the most effective fund that I'm going to use for my retirement, but is my 401k an effective plan? And lastly, since I'm going to be looking at things like buying term and investing the difference, I want to price in the term insurance, because most Americans who have a plan, most Americans also have outside the plan, they have some sort of protection in life insurance. Could be group with their employer, they could have individual policies, and term insurance being so cheap as it is today, and how cheap is it? A female, 25, super preferred non-smoker, her actual premium is about, the best one in the market is probably $85 a year, and $65 of that is a policy fee. So we're looking at the huge revelation on mortality revolution. The numbers are just getting bigger. The longer we live, the price tag goes down. For decades, registered reps, RIAs, and fund managers have pointed out the cost of life insurance. And again, we've fully disclosed it. We have no choice. We've been putting it on all our proposals and illustrations for years. And then I wanted to look at ours. We have policy fee, we have administration cost, we have premium loads, we have per thousand charges, we have cost of insurance, which is generally the highest cost, and then I have loan costs when I take distributions at retirement. And if I'm in variable universal life, I am going to have sub-account management costs. Now, before we go too much further, I want to show you something a little bit that I think you'll find as revelatory as I did. When I'm looking at the basic real cost, there's an article that came out in Forbes that was excellent, done by a CPA out of Wisconsin. And this excellent is Bernanke, no relationship to the former Fed chairman. And they took all the expense loads, the ratio expense, the transaction costs, including the cash drag, soft dollar costs, and advisory fees, and they put it and they plotted it out. They split it between two basic thinking. One would be qualified money and one would be non-qualified money. And for qualified money, the expense load was the average. This is the average, was 90 basis points for the fund expense. The transaction fee cost, which is in the statement of additional information, which most people don't see, is actually more than that on the average. It's 144 basis points. And then the cash drag is 83%. When you have a fund that has to stay liquid and has part of their funds in cash, you're not making very much on that with the low interest rate environment that we have. So sometimes the expense load and the actual statement of additional information fees, those transaction costs are greater than what they're paying. So there could be a cash drag depending upon how liquid your fund needs to be and how much money they have in cash equivalents. When you look at the actual taxable or non-qualified, then you're looking at expense loads, the transaction costs, the cash drag, and any tax costs. Think about this. So outside a qualified plan, the average might be 4.17. You're paying 4.17% for a typical average taxable fund or ETF. Now, ETFs are going to be a little bit cheaper than this. This is just an overall an item for mutual funds. But I'm looking at all the expenses to see what my costs are. And by the way, a little side note, every January we go through this. In January, we get our statement for the year. And it shows some clients will get a statement that shows a negative year. So they didn't have a profit that year. And they didn't use it for any tax harvesting at the end of the year. So they look at their statement and they say, oh, I lost a little money here. I lost 2 or 3%. Then they get about a week after they get their report on their mutual fund, they may experience, all of a sudden they get a 1099 for the same fund. And they say, what happened here? I had a fund that actually lost money and I still have to pay taxes on that? Because there's trading going on throughout the year. And those trades, if there's any gain, that's all pushed down to the actual investor, the person who owns the fund. So sometimes remember, there's some difficulty here because not only if you had a loss position in your fund, but you may actually have to pay taxes on a loser fund. That's a big item for clients. Oh, sorry. Let's go back and let's look at a life insurance contract, and I'm going to go from kind of east to west here. If I put in $10,000 into a contract, I'm going to have an expense load. Now I'm using a carrier. Everybody's different. So you're going to have to look at every carrier's expense load. And by the way, I like to make the difference between performance and the actual product costs. I don't try to mix them together. I want to see what the product is by itself without any crediting rate to it. It'll really give me an idea. But in this case, I'm just using a typical proposal, putting $10,000 in, and my expense the first year, they have a premium expense charge of $1,000. That's right off the top. That's 10%. And the succeeding years are $600. So why he's paying that, he'll be paying that for 20 years, this fee. And then the monthly expense charge is also going to be assessed to this. And you'll notice that after the 6th year, in this case, it goes down quite a bit to $240. Then the cost of insurance, the actual death benefit cost. And by the way, in this scenario, I've asked the computer to give me the lowest death benefit under the TAMRA compliant regs so that I can actually have the best tax accumulation and tax-free distributions later on. And so I'm looking at the cost of insurance. So I've suppressed the death benefit according to the code as low as I can get it. So when I'm looking at basic expenses like this, I have to put those expenses against a mutual fund or against an ETF or against a REIT. And I have to look at, is this a good idea or not a good idea? Now, as you go down through the years, notice that the premium charge, once I stop paying, there is no more premium expense. The monthly expense is at $240, and my cost of insurance is now sitting at around $247 in my opening year of distribution. Now, it does go up because you're paying an annual renewable term, but think about it. By the time you get all the way out to age 100, the actual expense load for the policy itself is going to have to be somewhere around a point to a point and a half total all in during distribution for me to really be efficient and effective with my total rate of return, my actual return that I get to keep. One little side thought on this is there's probably a crossover point between the 12th and the 13th year comparing against regular mutual funds or ETFs. ETFs probably a little longer. So the expense loads in a life insurance contract for the first 12 years, you're not going to be able to win. It's definitely going to be a mutual fund or an ETF call. So if you're a short-term player, that's the way to go. Life insurance is really a long-term play, and especially if you're doing tax-free, you have to keep the contract in force for the life of the client. That's going to be forever. So we're not just talking about a long-term investment, we're talking about for a forever investment. So once I cross over that 12th or 13th year of the mutual fund and a little longer, maybe 14th year with an ETF, expenses themselves, I'm going to start winning. And it's that long haul where my expenses start to play. The issue now is what kind of life insurance am I going to buy? And that's going to be coming up in another session that we're going to talk about. So when I'm looking at basic ideas, I'm just looking at what is my expense loads for what I buy in a mutual fund, an ETF, or what if I'm going to buy a REIT as an example or other alternatives, and I'm going to put that against my non-qualified life insurance because I get the tax deferral accumulation and I can take this out tax-free as long as I keep the policy in force for the life of the insured. And I showed you that. In general terms, the crossover year for the average financial product versus a managed life insurance cost is about between 12 and 13. And I use the word managed because, again, I suppress the death benefit under the code so that I could really try to get as much accumulation and much tax distribution as I could, tax-free distribution. And these are the three basic ideas that we're going to walk through so that you can understand the mechanics of this in our next segment. This has been part 3 of our 5-part series entitled The Power of Tax-Free Retirement Income. For more information about the subject matter in this workshop, just email me at ssavant@creativeone.com.